Every business needs to spend money to operate, whether it's buying goods, paying for service, or settling bills. But in this world of auditing, every one of these spending activity is more than just a transaction. It's a trail of evidence. That's where the acquisition and payment cycles come in. In this test, I will identify the account and classes of transactions involved in this cycle. Starting with step 1, account involved. Number 1, purchase or inventory. This account records the value of goods or service acquired. For trading companies, it's often recorded as purchases, and for manufacturing, it may be inventory. Number 2, accounts payable. This represents the amount the company owes to supplier after receiving goods or service but before making payments. Number 3, cash or bank. This account is used when the company makes payment to settle outstanding amounts owed to suppliers. Number 4, purchase, return and allowance. If the company returns goods due to defect or over-ordering, this account records the reduction in purchase. Number 5, accrued liabilities. These are expenses that have been incurred but not yet paid or invoiced, such as electricity or wages. Number 6, prepaid expense. If the company pays in advance for items like rent or insurance, it's recorded here and expense over time. Number 7, goods received not invoiced. This temporary account is used when the goods are received but the invoice has not yet arrived to match cost and to correct the period. Now, let's move on to the second part of step 1, identify the classes of transaction. Number 1, purchase transaction. These are initial purchase of good or service. It starts with placing an order and end with the item are received and invoiced. Number 2, cash disbursement transaction. These are payments made to suppliers, typically through bank transfer, check or online payments. Number 3, purchase, return and allowance. When goods are returned or discount are received for damaged or oversupplied items, it results in adjustment to the purchase. Number 4, accrual transaction. These are recorded when an expense is incurred but not yet invoiced, or paid like wages, payable or unpaid utilities. Number 5, prepayment transaction. Payment made in advance such as insurance paid upfront are recorded as prepaid and then gradually expensed over time.
Now, I will be presenting step 2 of the audit process in acquisition and payment cycle, which is to describe the business function and related documents. Let's go through 4 key business functions together, along with their supporting document and audit context. So the first business function is processing purchase order. This step starts when a department identifies the need to buy goods or services and initiating a purchase based on internal request. So the document involved is, first of all, we have purchase requisition prepared by internal department like production or maintenance. It formally requests approval to purchase specific items. The second one is purchase order issued by purchasing department to the supplier. Once approved, it includes details such as item description, quantity, price and delivery terms. Nowadays, this is often sent electronically using EDI. So the purpose of this function is to formalize the company purchasing intent and make sure purchases are properly authorized. And then from an auditor's perspective, reviewing purchase order help ensure that all purchases were approved and are genuinely needed. This support authorization control and help reduce risk of over-ordering or fraud. And then the second business function is receiving goods and services, which happen when verifying and accepting delivery of goods or service from vendors. So document used, first of all, we have receiving report prepared by the receiving department to record details such as the quantity received, date and condition of the goods. And then this document proves that the company actually received the good order, and it triggers the next accounting step of recognizing the liability. And then, from the audit point of view, the receiving report helps confirm the existence and completeness of inventory and account payables. It also helps prevent unauthorized purchases. And then the third business function is recognizing the liability, meaning recording how much the company owed the vendor. And then document involved, first of all, we have vendor invoice, show the amount due. And then debit memo issued by the company to reduce payment if item were damaged or returned. And then we have voucher, combine the purchase order, receiving report and invoice into a single package for approval. And then acquisition transaction file and acquisition journal, store and summarize accounting entries. Next, we have account payable master file and account payable trial balance, track amount owed to each vendor. And lastly, we have vendor statement and internal document from the supplier to verify the company records. So the goal of this function is to ensure that liability are properly recorded once good or service have been received. And then, from an auditor perspective, matching the invoice, receiving report and purchase order help ensure accuracy and prevent overpayments, supporting the accuracy and cut-off. And the last one, we have process and recording cash disbursement. The final business function is process and recording cash disbursement, making the actual payment to the vendor and recording it. So document used, first we have check or electronic payment, which is to proof of payment, and then we have cash disbursement transaction file to record payment detail, and cash disbursement journal to summarize all payment made. So the purpose is to ensure payment are made accurately, only for approval purchases, and are properly recorded in the accounting system. So auditor check that payment match approval voucher, segregation of duties between approving, making and recording payments, help detect or prevent fraud, reviewing the disbursement journal supports completeness and proper authorization. So in summary, these 4 business functions from processing purchase order to recording payments are supported by the specific document that help ensure accurate accounting records.
For step 3, I'll be talking about key internal controls in the purchase and acquisition cycle. Internal controls are the policies and procedures put in place by a company to ensure transactions are properly authorized, assets are protected, and records are accurate. Strong internal controls are crucial to reduce the risk of fraud, error, and misstatements, especially in areas involving purchases and payments. Now, let's look at 4 key internal controls that play a major role in this cycle. Firstly, we have authorization of purchases. Before any goods or services are bought, there must be proper approval, usually by a manager or department head. This helps ensure that the purchases are necessary, within budget and met from approved suppliers. Without this control, companies may face unauthorized or unnecessary spending, which can lead to financial losses. Secondly, the separation of asset custody from other functions, also known as segregation of duties. This means the person who physically handles the goods or inventory should not be the same person who approves or records the transaction. This reduces the chance of fraud because it requires collusion between 2 or more people for wrongdoing to occur. It also helps detect errors more easily when responsibilities are divided. Thirdly, we have timely recording and independent review. All purchases should be recorded as soon as possible once the goods are received. Timely recording ensures that expenses are reflected in the correct accounting period. An independent review by someone not involved in the transaction helps to verify accuracy, detect any inconsistency, and prevent manipulation of records. Lastly, there's authorization of payments. Before any payment is made to a supplier, it should be checked against supporting documents like the purchase order, delivery note, and invoice. This control ensures that the company only pays for goods actually received and avoids overpayments or fraudulent transfers. Having true signatures or approval limits for payments further strengthens this control. Next, I will explain how we perform tests of controls in the purchase and acquisition cycle. Tests of control are procedures performed by auditors to determine whether a company's internal controls are working effectively in practice. This helps auditors to decide whether they can rely on these controls and reduce the need for detailed substantive testing. Now, I will go through 4 key controls and explain how we test each one. To test the authorization of purchases, we would select a sample of purchase orders and check whether each one was properly approved by an authorized person such as department head or manager. We will look for evidence like signatures, approval stamps, or system-based authorization. This test helps us ensure that all purchases are made with proper approval and not done without management knowledge. Next, to test the segregation of duties, we will examine the company's organizational chart or job description to confirm that different people are responsible for authorizing purchases, receiving goods, and recording transactions. We may also observe the process in person or conduct interviews with staff to confirm that duties are actually separated in practice, not just on paper. This helps reduce the risk of fraud and error. Next, to test the timely recording of transaction and independent review, we will select a sample of goods received notes and compare the dates to the entries in the purchase journal. We check whether the purchases were recorded promptly after receiving the goods, usually within a day or 2. We will also look for signs of independent review, such as initial or supervisor sign-off, to ensure that the transaction will be reviewed for accuracy. To test the authorization of payments, we will take a sample of payment vouchers and examine whether each payment was supported by the necessary documents such as the invoice, purchase order, and delivery note. We will also verify whether the payment was authorized by the appropriate signatory and, if required, check for dual approval. This control ensures that the company only pays for valid and approved purchases. In conclusion, by performing this test of control, auditors can assess whether the company's internal controls in the purchase cycle are being followed properly. If the results are satisfactory, the auditor can place more reliance on these controls and reduce the amount of additional audit testing.
There are several types of analytical procedures that are commonly applied. Firstly, auditors compare acquisition-related expense, account balances with those of prior years. This helps to detect possible misstatements in expenses or account payable. For example, if the current year's acquisition expense appears significantly lower than the previous year, it might indicate that some purchases have not been recorded. Secondly, auditors review the list of account payable for unusual, non-vendor or interest-bearing payables. This is to ensure there are no classification misstatements, such as recording non-trade liabilities under account payable. Thirdly, auditors compare current account payable balances with those of previous years. If there is a large drop without a reasonable explanation, it could suggest that some liabilities have not been recorded at all. Lastly, auditors calculate relevant ratios such as purchases divided by account payable or account payable divided by current liabilities. Significant changes in these ratios compared to prior years or industry norms may indicate potential errors or omission in the financial statement.
Now I will be explaining about step 6 in acquisition and payment cycle, which is perform substantive test of transaction. So in this step, the auditor performs substantive test of transaction to obtain audit evidence regarding the validity, completeness, accuracy, proper classification and correct timing of recorded transaction. These procedures are designed to detect material misstatement in the financial record related to purchases and payment. So there's actually have two parts of substantive test. So I will be explaining about part A, which is substantive test for acquisition. So this procedure focuses on testing purchase transaction from initiating to recognition in the accounting records. So first of all, we have occurrence. So objective to ensure that recorded purchases actually occurred and relate to the entity. So audit procedure bounds a sample of transaction from the acquisition journal to supporting document such as purchase order, receiving report, and the supplier invoice. So purpose to detect fictitious or authorized purchases. And then we have completeness, objective to verify that all purchases made during the period have been recorded. So audit procedure, first of all, we have trace from a file of receiving report to the acquisition journal. And this is the second one, we have trace from a file of vendor invoice to the acquisition journal. So purpose to identify any unrecorded liabilities or omissions. And then we have accuracy, which is objective to confirm that purchases are recorded at the correct amount. So audit procedure, first compare recorded transaction in the acquisition journal with the vendor invoice, receiving report and other supporting documentation. So and then recompute the clerical accuracy on the vendor invoice including discount and freight. And then the purpose is to ensure financial reporting and prevent overstatement or understatements. And then number 4, we have classification. Objective to ensure that transactions are recorded under the account. And then the procedure compare classification with chart of account by referring to vendor invoice. So the purpose is to prevent misclassification between expenses and assets. And then number 5, we have timing, which is the start off. Objective to confirm that purchases are recorded in the correct accounting period. So the audit procedure to compare dates of receiving report and vendor invoice with dates in the acquisition journal entry. So the purpose to ensure proper period recognition, especially at the year end. And the last one, we have posting and summarization. So objective to verify the accuracy of recording and summarization in the accounting system. So audit procedure test clerical accuracy by footing the journal and tracing posting to general ledger and account payable and eventually master file. So the purpose to ensure completeness and accuracy in posting. Next, I will be explaining about the second part, which is substantive test for payment. So this section evaluates the recording of cash disbursement to suppliers. So as usual, we have number 1, which is occurrence. First, audit procedure, review the cash disbursement journal, general ledger, and account payable master file for large or unusual amount. And the second one, we have completeness, which is reconcile recorded cash disbursement with the cash disbursement on the bank statement, which is this is actually the proof of cash disbursement. And then number 3, we have accuracy, which is compare cancelled checks and electronic bank record of disbursement with the related acquisition journal and cash disbursement journal entries, recompute cash discount and prepare a proof of cash disbursement. And then number 4, we have classification. Okay, compare classification with charge of account by referring to vendor invoice. And then timing, compare dates on cancelled check or electronic bank record with the cash disbursement journal. Compare date on cancelled check or electronic bank record with the bank cancellation date. And the last one, we have posting and summarization. Okay, to test clerical accuracy by footing the journal and transferring posting to general ledger and account payable master file. So, substantive tasks of transaction provide critical audit evidence to evaluate the integrity of acquisition and payment transaction. This procedure helps ensure that all relevant purchases and payment are valid, complete, accurate, properly classified and recorded in the correct accounting period. They are especially important when internal control are weak or where there is a risk of material misstatement.
Ever wondered how auditors can be sure a company is not hiding unpaid bills or overstating profit? Well, that's where we come in, with the test of details of balances. It's the final and most revealing step in the audit of the acquisition and payment cycle, and it's all about finding out whether the company is telling the full truth about what it owes. Now, I will walk through step 7, audit procedure under the test of details of balances for the acquisition and payment cycle. Number 1, reconcile the account payable sub-ledger to general ledger. The first procedure is to reconcile the account payable sub-ledger to general ledger. This means we compare the total amount owed to supplier according to the detailed records with the balance record in the system accompanying main accounting system. If the balance don't match, it could indicate posting errors, omission or problem with the accounting system that need to be investigated. Number 2, examine supporting documents. Auditors select a sample of balance from the accounts payable listing and inspect the original document. By matching document I stated in slide, it can confirm that the goods were ordered, received and billed properly, which support the existence and accuracy of the liability. Number 3, review subsequent payments. This step review payment made after year end, usually in the first few weeks of the new year. If a January payment is for goods received in December, it may mean the liability was not recorded correctly. This helps auditors identify unrecorded liabilities and test the completeness assertion. Number 4, perform cut-off testing. Cut-off testing ensures that transactions are recorded in the correct period. Auditors check documents from just before or after the year end to confirm their liabilities are posted to the right financial year. This is important for testing the cut-off and completeness assertion. Number 5, compare vendor statement with company records. In this procedure, auditors request vendor statement and compare them with the company's account payable records. If a vendor statement shows an amount owed that is not recorded in the client's books, this could indicate a missing or late entry. Reconcile vendor statement helps us ensure the accounts payable balance is complete and accurate. Number 6, review accrued liabilities. Accrued liabilities are expenses that have been incurred but not yet paid or recorded. Auditors check how the company estimates this amount whether their method is used reasonable. This procedure helps the test valuation and completeness of the balances. Number 7, send confirmation to suppliers. Finally, auditors may choose to send confirmation letters to suppliers. This is especially helpful when the payable balance is zero or unusually low. Although confirmation are mostly commonly used for receivable, they can also provide external evidence to support the accuracy of accounts payable and help identify any missing liabilities. In conclusion, this procedure helps auditors obtain reliable evidence that the company liabilities, such as account payable and accrued expense, are fairly stated. Each step supports different audit assertions and strengthens the credibility of the financial statement.
I will identify and explain several internal control weaknesses found in the payment cycle based on the case provided. These weaknesses can affect the accuracy of financial records and the overall effectiveness of the company's procurement and payment processes. I will highlight and elaborate on 5 main weaknesses that can be observed from this question. Based on the case provided on the purchase requisition and ordering process, one issue that can be highlighted is that junior staff within the purchasing department have on several acquisitions both prepared and approved purchase orders. This can identify as a weakness in internal control. Normally, the duties of initiating, approving and recording transactions should be separated among different individuals to ensure accountability and prevent manipulation. Allowing the same person to handle both preparation and approval increases the risk of fraud or undetected errors. Therefore, the first weakness we can explain is the lack of segregation of duties within the purchasing process, which significantly weakens internal control. In another part of the case, on receiving of goods and services, it is stated that there is no physical verification of the quantity or condition of the item received. This clearly indicates a second control weakness. Proper verification of goods received is crucial to ensure that what was ordered matched what was delivered. Without physical checks, discrepancies such as short deliveries, oversupplies or damaged goods can go unnoticed. Hence, the second weakness is the failure to physically verify the quantity of goods received, which increases the risk of financial loss and weakens control over the payment process. Lastly, In the invoice processing section, it is mentioned that the supporting documents are not consistently attached or detailed. This highlights a documentation weakness. Proper retention of supporting documents such as purchase order and goods received notes is essential to verify and validate supplier invoices before payment. Therefore, the third weakness is the inconsistent retention of supporting document, which refers to the failure to systematically keep and attach key record needed to support the accuracy and legitimacy of payment transaction.
Internal control weakness number 4 is no dual authorization for online payment, which is from study case. We can see the finance manager has authority to both initiate and approve payments independently. This is because there is no segregation of duties in the payment process, because the finance manager alone can initiate and approve online payment without a second person reviewing or authorize the transaction. This violates a core principle of internal control that no one person should have full control over a financial transaction from start to finish. Without a dual approval process, the company has no oversight over payment being made, creating an environment vulnerable to error or international misuse. Next, weaknesses number 5 is no routine reconciliation of account payable with suppliers statement. We can see from study case that there is no routine reconciliation of the account payable ledger with supplier statement. The company does not regularly reconcile its account payable ledger with statement received from suppliers. This is significant internal control weakness, as reconciliation is essential to ensure the accuracy and reliability of recorded liabilities. Without this process, the company cannot confirm whether all suppliers' invoices have been properly recorded or whether there are duplicate entry or mistake in balances. It reflects poor financial oversight and weak monitoring over obligation to suppliers.
Internal controls in the purchase and acquisition cycle are essential to ensure that transactions are properly authorized, recorded and protected from fraud. As auditors, our role is to identify any weaknesses in these controls that could lead to financial loss or inefficiency. Here, I will highlight some key control weaknesses in the purchasing process and explain the risks or consequences that may arise if they are not addressed. Firstly, junior staff both prepare and approve purchase orders. This first weakness is a classic case of poor segregation of duties. When the same junior staff member is responsible for both preparing and approving purchase orders, it eliminates any independent oversight. The two main risks here are: first, there's a high risk of fraud and unauthorized purchases. One person can easily create fake purchase orders for fictitious vendors or make personal purchases disguised as company needs, which can make them approve without anyone noticing. Second, the company suffers from a loss of control over spending. Without management review, purchases can exceed budget limits or go to unapproved suppliers, which not only waste resources but also undermines procurement policies. The second issue is the lack of physical verification of goods when they arrive. This means there's no proper check to confirm the quantity or condition items before they are accepted and recorded. The key risks are: firstly, the company may overpay or pay for goods not received or damaged items. For example, if a delivery is short or defective but no one checks, full payment may still be made, which can lead to direct financial loss. Secondly, it results in inaccurate inventory records. If missing or incorrect goods are recorded as received, the stock count becomes unreliable. This can lead to stock shortage, production delays, or even theft going undetected. The third weakness is the inconsistent handling of documentation, such as invoices, purchase order, and receiving reports. These documents are essential for validating purchases and payments. The main risks here are: number 1, there's a higher chance of duplicate or erroneous payments. Without clear records, finance may process the same invoice more than once or pay them without confirming whether the goods were actually received. Secondly, this poses serious audit and compliance issues. Missing documents make it hard for auditors to verify transactions, increasing the risk of audit qualification. It can also result in tax or regulatory penalties due to lack of proper documentation.
Next, fourth is the finance manager has the authority to both initiate and approve payment independently. The risk from this weakness is the opportunity for fraud or unauthorized transaction. Since the finance manager has full access to initiate and approve payment without independent review, they could process payment to the wrong supplier's personal account or fake vendor without being detected. Another consequence is the loss of accountability. If an error or fraud does happen, there is no audit trail showing who should have prevented it. This may also damage the company's reputation with banks, stakeholders, and auditors, who may see this as a major financial control failure. The fifth risk, there is no routine reconciliation of the accounts payable ledger with supplier statement. Without regular reconciliation, the company is exposed to the risk inaccurate financial reporting. It may overstate or understate its liabilities. which affect the true and fairness of the financial statement. Additionally, duplicate or missed payment may go unnoticed, leading to financial loss or supply dispute. If a supplier believes they are owed money, but the company's records say otherwise, it can delay future transactions or even damage supplier relationship. Over time, this can also increase audit issues as outstanding balance may be not properly supported by documentation.
Effective internal controls in the purchasing cycles are crucial to prevent fraud and ensure transactions are properly authorized. One key issue identified is that junior staff are both preparing and approving purchase orders. This lack of segregation increases the risk of unauthorized or fraudulent purchases. To address this, I recommend two key improvements. Firstly, enforce a clear segregation of duties. Junior staff should only prepare purchase orders, but approval must be done by a supervisor or manager. This ensures independent oversight and accountability. Second, apply system-based access controls. The procurement system should restrict users from approving their own purchase orders. Automated role settings and approval workflow can help enforce this consistently. These two controls, separation of duties and system restriction, will significantly reduce fraud risk and strengthen the integrity of the purchasing process.
The second issue is there is no physical verification of the quantity of the item received. So the first internal control procedure or improvement is implement an independent receiving department. So this team can physically count and inspect goods when they arrive. They check quantity and condition against supporting documents like the supplier delivery note and the company purchase order, and this helps prevent fraud because no single employee control ordering, receiving and buying. So this procedure supports the control objective of accuracy and validity, ensuring only goods are actually received in good condition are recorded. Next, after physical inspection, the receiving department should prepare a pre-number receiving report for each delivery. So this report should show quantities and describe the condition of item received. Next, be matched with the purchase order and supply invoice before any transaction is recorded in the acquisition journal. And then using pre-number form help ensure completeness, and missing number can indicate unrecorded receipt. Next issue is about inconsistent verification of good receipt. So here is the recommendation. First of all, establish formal documentation procedure and retention policies. All acquisition transactions should require supporting document to be attached before posting to the acquisition channel. Documents should be filed sequentially. And keep in secure central location, either in physical file or digitally in an accounting system. So this support the internal control objectives of accuracy, which is only actual supported transactions are recorded and completeness, no transaction is missed. Next, the company should implement a formal three-way matching procedure before any transaction is recorded in the acquisition journal. So this procedure helps ensure first purchases are authorized, goods are actually received, amount are accurate, and it also helps detect error in billing, and international overpayment and fraudulent and duplicate invoice. Next issue that the finance manager has the authority to both initiate and approve payment independently. So to improve this, the company should implement proper segregation of duties. The initiation of payment should be done by the account or procurement department. The approval should come from different officers such as chief financial officer. And finally, the execution of the payment should be carried out by another finance staff or authorized signatory. So this separation helps ensure that no one person has full control, which reduces the opportunity for fraud and mistakes. And then the second recommendation is to apply dual authorization for all payments. This means that two authorized personnel must approve the payment before it can be processed. So dual approval add an extra layer of control and oversight, and that's especially for large or unusual transactions. It also ensures better accountability in the company's disbursement process. So the last weakness is that the company does not perform a routine reconciliation between the account payable ledger and supply statement. So to fix this, the company should conduct monthly reconciliation of the account payable ledger with supplier statement. By comparing the internal record to what the supplier provides, the finance team can catch any discrepancies yearly and correct them before financial reporting is done. So the reconciliation process should also be reviewed by an independent officer such as the finance manager or an internal auditor. So this ensures that the reconciliation was done correctly and that any difference were properly investigated and documented. It also strengthens the completeness and accuracy of the company financial statement. So in conclusion, strengthening internal control through segregation of duties, dual authorization, and monthly reconciliation can significantly reduce risk in the acquisition and payment cycle.